Hi, this is Randy Finney with the right side of the chart, and today is Tuesday, June 5th, 2018. In this video, I wanted to do a broad overview of some of the things that I'm watching right now, some things that stand out. So we'll touch on the broad markets. I won't get into depth on the charts there, but just kind of point out some of the key things that I'm watching right now, some of the developments to watch for. Maybe touch on a few sectors, not many. Also, I wanted to talk on bonds real quick. So we'll look at various asset classes, stocks, bonds. I want to look at oil as well, touch on that, gold and GDX. And then that sort of segues in. If there's time left at the end of the video, I'll cover the active trades on the site, all of those, because there are actually a few sectors that we have, sector ETFs. We also have GDX, which I'm going to cover in the video. We have long on bonds right now via IEF, and I've been highlighting TLT as a sister trade to that one, if you will. So again, so we'll hit on some of the trade ideas just going through the sectors or asset classes that I'm watching. And then again, time permitting, I'll cover I'll do an update on all the active trades. If not, I'll put out some post on any active trades that stand out right now, uh, any that look compelling, maybe some objective add-ons right now, like GE, for example, looks like a pullback to support. Treasuries, TLT as well. So before I get into that, let's just start out here with a brief discussion on the FOMC meeting, which is next week. So next Wednesday, 2 o'clock Eastern time, they'll announce their decision. And right now, it's pretty much baked in the cake. These are Fed fund futures. They're pricing in the 96%, 96.3% probability that we'll get a quarter point rate hike. Currently, we're at 150 to 175 basis points, which means 1.5 to 1.75%. So there's only about a 3.7% chance that they will not change rates, a 0% probability that they'll decrease rates, and a 0% probability that they'll increase anything more than a quarter point. So again, it's baked in the cake, so there'll be no surprises. And if the one thing about this Fed in recent years, they do not surprise. They telegraph all their moves well in advance. So, but the point to all this is, it's not what they do next week. We're going to have a quarter point rate hike. That's baked in the cake. It's what they say afterwards, what the accompanying statement that they provide. Will the Fed become more hawkish or more dovish than they've been recently? If so, that may change the trajectory, or at least the expected trajectory of future rate hikes. And by that, for example, again, if we get that quarter point rate hike next week, it's going to take us up to a Fed funds rate of 175 to 200 basis points. We look at the August meeting, and they have a 92% chance that's still where it will be. So in other words, the Fed fund futures as of now are pricing in quarter point hike next week. Nothing at the August meeting. That may be a lame duck meeting, by the way. Lame duck meetings are when the Fed doesn't have a scheduled press conference after the meeting, and it is extremely rare. Rarely ever have they raised rates during a lame duck meeting. So, and it's not going to happen at this point in time unless there was some kind of financial crisis going on. So either way, I don't know if that's a lame duck meeting, but I can tell you that it's priced in that they're going to keep. If we get that quarter point hike next week, there's a 92% chance that it's going to stay that way. In other words, no change at the August meeting. And then you roll into the September 26th meeting, and there is then a 65, at this point in time, today, a 65.7% chance that we'll get another quarter point rate hike, and about a 31% chance that they'll continue to leave rates alone after hiking next week. So again, this is what I refer to as the trajectory, or the planned, increase. We're on a rate hiking schedule, and we have been. They've got to take back a lot of these excesses. We're in a mode of quantitative tightening right now. Whereas a few years ago it was quantitative easing. And so again, it's not what they do next week as far as how much they hike. It's what the market's reaction is to what they say. That's what's going to matter. So let's just move on and look at the charts. Okay, starting out here, this is QQQ. My views on QQQ have not changed. I think we're looking at a correction coming up here. Nothing in the charts have changed. The markets have been very resilient in recent weeks, surprisingly resilient. I didn't think we'd get this much of a pop, but this is still just an extension of the divergences we've had since this point right here, this divergent line right here. Back here when we made a new high, when we took out that high from early May right there, the May or mid-May, May 14th high. At this point, we had negative divergence, and all that we've done is expand these divergences so far. And at this point in time, if you look down here, the PPO is rolling over. Here's the histogram. Sometimes it looks like you're going to get a cross like right here, and you don't. But as of now, I can see at high levels, and when I say high levels, this is about as high as the PPO usually gets on the 60-minute chart. You can go back here and just look at these, previous peaks. So this is what I call a pending, not it hasn't occurred yet. We need to turn down a pending bearish crossover, high-level PPO crossover. The histogram just tells you when you cross, when these two lines cross, I should say, up here on the PPO, then that goes red. Let's just park that for a minute there. So there you can see as we zoom in, you can see the lines turning down and rolling over. Cross appears imminent. It looked like we were going to get one there, and we didn't. Sometimes they bounce, but they tend to bounce much more often at lower levels than at higher levels. You get stretched, you're overbought, et cetera, et cetera. You can go here, draw a little trend line right here, short-term trend line, which has been broken. I believe I posted that the other day on an intraday chart, but there it is. So we've now broken that, and the market's just gotten, especially, it's not so much the market. The QQQ has gotten ahead of itself. It's just reading in the journal today, this morning, the FANG stocks, not my FAAMG, but they use the acronym FAANG. I prefer to leave Netflix out of that because it's not one of the top 5 components. But either way, the FANG stocks have outperformed the S&P 500 by 30% so far this year. And I've recently done analysis where I've looked at the QQQ or the NASDAQ 100 versus the NASDAQ 100 equal weighted index, and the outperformance of the FANG stocks is extremely concerning in my opinion. It's been those 5 stocks, what I call the FAMGs, FAAMG. That's in order of market cap: Apple, Amazon, Alphabet, which is the G, Microsoft, and Facebook. Those are the 5 largest companies in the NASDAQ 100, and that's what drives, and that's been the big driver of this rally. So looking at, breadth deterioration, everything else, you're not seeing the rest of the market keep up. Either way, call it what you want. I'm looking at a likely pull back here, and let's see, on the daily chart we also still have, we actually are just a few basis points away from a divergent high. We have to look at this previous reaction high on March 13th. That high was at 175.21. So far today we had a high of 175.13. Now this is also splitting hairs. Technically speaking, you have to have an equal or higher high in prices with the indicators making lower highs to have negative divergence. But for all intents and purposes, that's an equal high. I mean, we're talking pennies on a $175 a share ETF. So we virtually, if we can turn down here, now these are what I call unconfirmed divergences. Why unconfirmed? Because the PPO is still pointing up. That's a momentum indicator, and the RSI as well. Those are momentum indicators. They're pointing higher. So there's a potential, if we keep moving up, at some point, these divergences are then burned through. We now have higher highs in the indicators. We have to take out these previous highs from back here, earlier in January. If we take those out, then there's no longer divergence there. It's not the end of the world. It's not the be-all, end-all for the case for correction, but it certainly does dampen things there. So that's the cues on a bigger picture. There's a 60-minute chart. And when I drill down the components, again, this is what's driving the market. Make no mistakes about it. If I had the time, I'd go through and show you the comparisons of the equal weighted and the non-equal weighted, the top heavy NASDAQ 100, but this is what's driving it. These 5 stocks. Apple, there's your divergent high right there. We had a divergent high here, a very small one, and these divergences, this is very clear negative divergence. If you look at the PPO, look at the slope of that line as we make a new high. So what I'm getting at, there's certainly room if Apple wants to push a little higher, and these divergences will still very much be intact for at least for quite a while till they're burned out or taken out. And as I've gone over this, these divergences, they are not the be-all and end-all, but much, much, much more often than not, they do play out for a trend reversal or correction. Sometimes little divergences play out for little corrections. Sometimes, or very often, the larger the divergences, the larger the drop. As you can see here, tried to grab an arrow, a tool there, but there it is. divergent high and divergent lows. Likewise, they play out for rallies, just like as indicated here. So that's it. There's Apple, the world's largest stock, the top component of the Nasdaq 100, the largest component of the S&P 500 as well. Here's Amazon pushing up, making a divergent high. Still not confirmed. We need to reverse, but one thing I want to show you real quickly, just going back to that QQQ 60-minute chart, is very often once you get that crossover, let's just look at some of these trend line breaks. And again, as I often say, divergence in itself, just like overbought in itself, is not a sell signal. It is merely an indication that a trend reversal is likely. But what you need is a sell signal. So that sell signal can come in the form of, you know, bearish candlestick patterns. It can come in the form of a trend line break or both. But usually when you get it, the selling is pretty impulsive after a strong advance like this, and you don't really have time to get out. So you watch these trend lines. Here's a minor trend line there. Watch for the bearish crossover. That will confirm the divergence. Watch for this RSI to cross back below the 60 level. Those are some of the things I'm looking for in QQQ. Here's Apple. Again, going back to the top components, there's all your divergent highs, so that one's yet to be confirmed. Let me just go back here so I can pull up my watch list down below the components. Amazon, negative divergence there. Actually, you may have just popped above it on the RSI. No, we're about equal highs, so there's still, it needs to reverse soon. I'll say that now. We had a little wedge here. We have a little wedge overthrow. To keep this chart well intact, to keep the case for reversal healthy and alive, it's preferable, but not necessary to see divergence on both indicators. But sometimes you only get divergence on one of the two, and it still plays out. But there's Amazon. Here's Alphabet, GOOG. There it is. You can see we already have in progress, or any more downside from here, a high-level bearish PPO crossover. Last one we had was right here. And you can see from that point right about there is where the lines actually cross. It was just a hair more upside and then a pretty decent correction that lasted for a couple weeks there. We had a high-level bearish PPO crossover right here. You can see that was a very significant correction. And again, that's what I'm looking at right now. There's the other share class, GOGL. Here's Microsoft. Same story across the board on all these top components. I don't want to beat a dead horse, but these charts are in alignment. These stocks are pushing the upper limits of these divergences. And here's Facebook, 60-minute divergences. Minor. You can look at looks to be a little minor trend line here, but again, you'll know it when you see it. You'll start to see some impulsive selling if and when we get a reversal. You'll see these. We need to have another. Oh yeah, no, we still have a bearish crossover there. I thought these lines had come back over. So yeah, it looks to me like this run is long in the tooth, and we've probably seen the extent of it this week. We're probably looking at downside from here. But again, we don't have sell signals yet. And if there's one thing this market's taught us lately is don't try to jump the gun. I did that recently with an Intel trade. We're going to get to the semis in a second here. In fact, let's do that now. Let's look at semis because semis are tech. The NASDAQ 100 is tech, these FANG stocks. It's all about technology. That's what's been running this market up. Technology has by far and wide outperformed all the other sectors, and it is almost, I can't say single-handedly, but to a very large extent, the primary driver of this rally, and really over in recent years and throughout the bull market. So tech needs to go. And here's the example. We had a short on Intel last week. It was, we were stopped out for a minor loss. And at the time of taking it within the trading room, I posted that SOX, it looked like an imminent breakdown. We had this minor trend line. I said SOX needs to break this trend line. SOX, by the way, is the PHLX semiconductor ETF, semiconductor sector ETF. But it never did break that trend line. So we had divergences, but as I said before, divergences in themselves are not a sell signal. I thought we were going to break down, but we didn't break down. You can see it's a well-defined trend line. We held support, and I left that divergence line there to point that out. This is how I showed it in the trading room last week. But what happened is the semis found support, held support, defended it, and had another thrust up. So at this point in time, that previous trend line is really no longer valid anymore. That didn't prove to be, at least those divergences didn't play out. But what did happen is the divergences were extended. So we still have very much negative divergences, and you can see the PPO is starting to roll over, but it hasn't crossed. So Bearish development number one would be a bearish cross on the 60-minute PPO that would confirm the divergences. Also look for some candlesticks, bearish golfing candles or any other type of candlestick reversal pattern. And then ultimately a break of this trend line right here. And that will most likely mean that a correction is now underway in the semiconductor sector. So that's stocks. Biotech's another one that I mentioned yesterday. Early in the day, we had what was a potential bearish engulfing candlestick. I pointed that out in the trading room, maybe even on the front, yeah, on the front page, I believe. And the case for a potential top is still very much intact. We had divergent high number one there. We had a sharp correction. Divergent high number two, sharp correction. Divergent high number three. And again, the point is this is a triple top. We've had three failures so far at this 97.90-ish level in the biotechs. Three failures. And yesterday, you can see that long candlestick shadow or tail down there. That means early in the day, we were engulfing that candle, but this was what we call a stick save. By the close, they managed to rally up and they printed the body of this candle was above the bottom of that one. So we don't have a bearish engulfing. However, that doesn't mean that the bearish case is completely thrown out the door and you load up long in the biotech. Far from it. We still have failed, and yeah, we have another red candle, another failed attempt here at this 97.90 level. So let's just watch what happens here in biotechs, and we may have a swing short op. But again, this market's been very resilient, and that's why I'm hesitant. I've been sharing some trade setups recently, but my conviction isn't very strong. So a lot of those I'm sharing is unofficial trade ideas, and this one, as of now, is an unofficial trade idea. But I said it yesterday. If you want to, take a shot at a short on the biotechs here with a stop somewhat above, you just have to be aware that usually when you have a well-watched level like this, especially during a bullish trend, what they tend to do is they run stops. They see that retail traders they see that 97.90 level, so they're going to put a stop at 97.91. So what the market makers will do and the powers that be, algo trading programs, they see those stops. You and I can't see them. We don't have the money and the access to it, but those on Wall Street can, the brokerage certain, can. They know where the stops are, and so what they'll do is they'll hit those stop clusters, take out, break out to new highs. That'll suck in some longs, and they reverse and go short. And so my point being is you got to give it a little room if you are going to short it. We may not have that stop pop, but if you do, you need to give it a little bit of room to allow for that. Maybe wait for a solid daily close or two daily candlestick closes above, and you're still talking only a few percentage points for what could be, if you measure these previous moves down, and please keep in mind, if this is a triple top, and that does prove to be the case, you're probably looking at a deeper correction than those previous two. Let me just turn this off and tell you what those were. If I can grab the highs there, this drop from high to low was almost 16%, as was this one. You can see they're roughly equal, about, it's 15.85 on both of them. But a triple top pattern has longer term bearish implications. And the way to trade a triple top pattern is I'll find another board and show you real quick. I don't want to get off topic, but again, this is a potential trade idea. There's the triple top. And again, maybe we pop a little through it, maybe we don't. But you look at the bottom, this one's not super well defined, but you try to box it in like this, you might say there were a lot of reactions here. So then you can do like this, a box tool. Oh, wrong. Here's our box tool here. So there's your triple top pattern, and the measurement is you take from the high to the low, and you add that to where the pattern breaks down, and that gives you your measured target. It's just an approximation, but the point that I wanted to make is that if this does prove to be a triple top and you're able to short here and you tuck away and allow this to be a potential runner trade, I mean, one of two options. You can either swing down to the bottom of the channel, which is support, or the sideways trading range, and then cover, or just trail your stops down, maybe set stops, to protect profits along the way, and allow for the bigger, what I call a runner trade. Again, some work to be done, so I'm not getting too excited on XBI yet, but I am very much watching it, and we'll see where we go from there. All right, let's move on a little quicker now. Let's get into bonds, TLT. I've been bullish on bonds for a while. I was bullish back here. Listed this one along with IEF. IEF was official trade. This one was I called it the sister trade because they're both Treasury bonds. TLT is just longer term, 20 to 30 year bonds. IEF is what is this 10 year, in that range on average. There's various maturities in there, but we swung it up. hit the second target, and reverse. We got out, and then we were able to recycle back in here. There's that what I was talking about in reverse a second ago with the triple top in XBI, how we had a well-defined support level here. Again, I've covered this in the past. Probably shouldn't spend too much time, but I always have new members coming into the site. So what we have is a very, very, very well-defined level. A lot of taps on this level here around 116.56, and then we had that little stop clearing raid right there where treasury bonds yields popped up, bond prices popped down, probably sucked in a lot of bond bears, and then they gunned it. And this is what it's so often the case when you have a failed breakdown or a failed breakout. The reversal is very swift because you have both the shorts in this case that piled in to short TLT and they get squeezed. They realize that breakdown failed. It was a false breakdown. And then you have the bulls, the natural buyers that say, wow, we held support. We broke it for a day, but we're back above. So they jump in and buy. And it was a swift move up. So we were able to catch that. Now, where I'm going with this, I'm doing an update here because I think this is an objective level. I've mentioned this. The midpoint was the first target back here on that first trade. We hit it. And we had reactions for a couple weeks there. Then we went above it. It acted as support once we took that resistance level out and went up to the second target. Then we fell below it. Once support was broken, we went back down to the bottom. And you can just see how many reactions. So this is a well-defined support level. And whether it pans out or not, I am still intermediate to even, well, let's just say at this point in time now, I'm near term and intermediate term bullish on treasuries. So you have this pullback to support. It's an objective entry. Doesn't mean it's going to play out, just means that it's objective. You go long here or add back to a position if you took profits right here, and you have a stop a little bit below. But we have this positive divergence right here that on the daily time frame should play out for a lot more than this little pop. So I'm looking at something like this, more upside in bonds. And again, maybe whatever the Fed says next week is a catalyst for that move. IEF, this is our still an active trade. We just had another dividend. I didn't update it right here, so don't pay too much attention to this. This was from the last update we had at that point in time. Before this dividend paid out on June 1st, we had a total of 52 cents in dividends paid out. And again, I mentioned this one before that I'm fine with these treasury bonds as part of a diversified portfolio asset allocation, even if it takes a while to play out, as long as we're not stopped out, because you're getting paid to wait in this thing. Here's all the dividends that we've had, and look at the nice increasing rate in dividends. March 1st, we were paid out 16 cents. Then we were paid out 17.5 cents on April 2nd. This is since we entered the trade. May 1st, we were paid out 19 cents. And now on June 1st, again, this is a record date. These other dividends were already paid out. June 1st, a record date means if you held IEF on June 1st, even if you sold it yesterday or today or June 2nd, you're still going to get that dividend. It's going to hit your brokerage account even though you no longer own IEF. That's what record date means. So you have the record date and then the ex-dividend date right after that. So if you owned it or still do, you're going to get this 20-cent dividend. That's going to then reduce our cost basis. As of before that dividend, our cost basis was about exactly, well, actually we're above our adjusted entry price is 101.77. It's at 101.87 now. Now subtract another 20 cents off that, and that means our adjusted basis now is about 101.57 after this dividend that you have coming. So again, this isn't a get-rich-quick trade, but I mentioned before, treasury bonds, because they are so stable, relatively speaking, you can take easily a 2 times, position. If you normally trade $10,000 in SPY, you take $20,000 in IEF because you're going to have a lot less volatility, a lot less downside risk. Your percentage losses are much smaller if stopped out, and your percentage gains if hit are also smaller. So that's why I talk about beta adjusting position size. You can have an oversized position in bonds, again, due to their relative stability. All right, moving on. Let's look at oil. Oh no, we didn't cover all the bonds. I covered the treasuries, LQD, our corporates, investment grade corporates. Pretty similar story. We had this divergent low. The treasuries are more secure than investment grade corporates. We broke back down below this trend line. It's not super well defined, but Again, I'm preferring the treasuries right now, but you'll get a little bit higher yield on LQD. I think if my call is correct, you had a divergent low right here. We'll regain this trend line and continue to move back up, and I think we'll hit eventually this at least this 117.48 target. That's my, let's just say, my preferred swing target right now in the coming months. That's LQD. And then JNK, those are junk bonds. I am not bullish on junk bonds. Junk bonds typically trade more in line with the stock market, with equities, and you can see that they've just been dead flat for weeks now, a couple months, hugging this support level here about 35.60. So the stock market, especially tech, continues to rise, yet junk bonds are not rallying. They're no longer rallying in line with the stock market as they had been for quite a while. So that's JNK. And if we give up 35.60 with conviction, they're probably going a lot lower. And if so, that most likely will coincide with a correction in the stock market. Oil. A lot of folks interested in oil. Oil had that big run up, and again, it was clearly priced in the charts. Here we had a divergent high. We took a shot at it on an official trade, got in a little too early, took out the stops, but I maintained my bearish bias, looking for a reversal. I was consistently bearish on it, knowing a top was coming. You can see it was priced in as clear as day. Negative divergence here at that high, negative divergence on the RSI, the PPO. We moved down impulsively, and then we hit support here. S1 was a trend line. If you zoom in, perfectly. Bounced right off that trend line, had a little reaction, and then went on to break the trend line. We also broke that 1327 support. And we're not far now from what was my first target way back then, and still is that 1287 level. There's a gap right there, but we'll look at CL futures, crude futures in a minute here. I think and I mentioned this yesterday in the trading room, and I'll get to it in a second. I think we're looking at a bounce here soon. We're oversold, not on the daily time frame, but we are on the shorter term time frame. So I'm favoring upside in crude. Maybe even a back test of this trend line here, and then more downside. Again, this is a primary, well-defined primary uptrend line following a divergent high. Let's look at CL real quick. Before we do, let me see if I have anything on the 60. Yeah, here it is. 60-minute chart. USO speaks volumes to me. We had a bearish rising wedge right here, divergent high. I don't have it marked though with the the annotations, but that trend line here, you can see the PPO and RSI negative divergence across the board. That played out for correction, but now we have a very clean bullish falling wedge right here. It's actually just broken out. So that's my view. I'm near-term bullish in crude. I think we get a pop here. You can see it was very oversold down here on the 60-minute RSI. I think we could pop up here. Right now, let's just say that's my preferred target, 1358 on USO, followed by a reaction there, and maybe that'll be the extent of any rally. But if not, if we go farther than that, I wouldn't short it there. I would go long and either take profits there or set a stop and let it ride. And we might get come up here and try to test the bottom of this gap around 1395. That could also coincide with a back test of the trend line that I showed you on crude a minute ago on the daily chart, on USO at least right here. So that's something to look for. Okay, these are crude futures, CL. This is a 60-minute chart showing you that same bullish falling wedge. Now, if whether you trade futures or not, I think you should keep an eye on them, because this is really you don't have this is the pure price. This is what crude is trading. This is what the professionals, this is what the institutions are trading. They're trading crude futures. Typically, they're not trading USO. It's an ETN, and like all ETNs, especially commodity tracking ETNs, they can disconnect from the actual price. So a minute ago, I said we broke out on USO, but when I look at this, there's a little more work to be done. I want to see a 60-minute candlestick close. So far, we attempted to break out, but haven't. There's a downtrend line. So it looks imminent to me, but at this point, but you want to see us get up here and close, print a 60-minute candlestick close above that trend line. You can see as I zoom in, look at that candle right there. We had a little pop above, settle back down, so we're right on downtrend line resistance right now on CL. This is my target right here on CL, 67.15. That's my minimum target. If we go up above that, I would give you another target right here. I would say right about there, top around that reaction high, about 68.68. That would be, well, no, can't quantify it right now for you, but those are the targets, the bounce targets. And we look at a daily chart of crude futures, and you can see there's that similar uptrend line to USO, very well defined, and this is the bigger picture. This tells me divergent high right here, a breakdown of the primary trend line. We bounced off it before we broke down, and which is very typical. We hadn't visited that trend line in a while. We had a little muted reaction. We've broken down. So, longer or intermediate term, I am bearish on this. Like I said, I favor a little kickback rally here. Maybe back test that wedge and then another move down. So near term bullish, intermediate term bearish on crude oil. That's that. All right, long video, so I think we'll wrap it up here with gold, and then I'll just have to update the trade ideas in another video. I'll cover GDX right now, even though since that is a trade idea and it's also related to gold. But there it is. Gold, this is a weekly chart. I've made mention. We have this triangle type pattern here with a gold at uptrend line support. So now it's 1, 2, 3, 4 weeks. 4 weeks we've successfully defended that trend line. Doesn't mean it can't break, just means this is an objective level. People want to buy things for some reason. They want to buy the FANG stocks right now. They want to buy Apple right now. Nobody wants to buy things when they're on sale. People wanted to buy gold here. Not me. I like to buy pullbacks if the trend is still bullish, which this trend is. This is clearly since the lows back in late 2015. We're making a series of higher lows here. Yes, given we need to take out this previous high over here to really say that gold is in a new strong bull market. I'm talking this high from back in mid 2016 right there, because a downtrend is simply defined as prices making a series of higher lows, which clearly we've done here, and also a series of higher highs, and that we don't have yet. We need to take this high out, and so what I'm watching here is let's punch through these levels here. That would be longer term bullish, but at the very least, I'm looking for a bounce, a reaction off this trend line, and if we get a solid weekly close, it would have to be a weekly close, and it'd have to be pretty impressive or impulsive too, for me to really abandon my bullish bias on gold. Here's GDX on a weekly time frame. Same thing. You can see a triangle type pattern here. We had a vicious bear market. We had a bull market here in the mining stocks. There it is, big bull market, followed by a bear market, and now what appears to be the early stages of a bull market. But we have to watch this trend line here. And the GDX trade, like I said, it's been a little frustrating, but it's one of many things. If you don't put all your eggs in one basket, nor should you ever, this is just one part of your portfolio. We're still profitable on this trade. I believe profitable. I'd have to look to see exactly where the entry is. Maybe break even, maybe slightly underwater, but we're well above the stop. And I really like how the gold stocks, the mining stocks, have been very resilient despite the weakness in gold. I'll look at euro real quick, probably because I usually cover um, the US dollar and the euro when I cover gold. And there it is, positive divergence here on the weekly chart. There's a downtrend line to watch. I'm sorry, this is a daily chart. My bad. But there it is, downtrend line. We've broken out. We back tested that downtrend line. We had divergence here on the RSI. And the bigger picture weekly chart, this just speaks volumes to me. We had a divergent high that led to this correction. Here was a big, divergent high. This was a bearish rising wedge, well-defined trend line. We broke trend. We've come all the way and we back tested this level. This was the top of a very, very, very important basing pattern from 2015, all the way from 2015 to mid 2017. In other words, I'll box it in. That was a basing pattern in the euro US dollar pair, meaning the euro was basing against the dollar. The euro broke out. We had one back test here, and now this is another back test at the top of that basing pattern. That is on a scale 1 to 10, that's got to be close to a 10 for support. That doesn't mean that support has to hold. It just tells you that if you're ever going to get bullish on the euro or look for an objective long entry, this is it. And if this plays out, if this support holds, that means euro rallies against the dollar falls. That would be bullish for gold. So there it is. That's my preferred scenario. Remains that way. Look at that nice hammer off that level too. Look at that, boom, and we're moving up so far. Trend indicator still bullish. Yeah, we had that divergent high, but it's very, very safe to say that wedge has played out for all of its measured move and then some. I mean, technical analysis, you just take the widest part of the wedge, which I've done right there. And you add that to where the wedge breaks down, and it gives you your measured targets. We've more than met the measured target for that bearish rising wedge pattern. And again, that's PPO signal line. The 9 EMA is still above the 0 line, indicating the trend is bullish. So that's my take. So I'm bearish intermediate term, near term, intermediate, and even longer term, bearish on the dollar, bullish on the euro, which means I'm bullish on gold. And we'll see what that does to oil. Oil seems to have disconnected from its inverse relationship with the dollar, but gold still has very much has a tight inverse correlation with the US dollar. All right, I will wrap it up here, and I will follow up with the agricultural commodities in a different video and maybe update any trade ideas that stand out at this point in time. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.